There's a stretch of years in most retirements that tax professionals quietly call the golden window. Most people let it close without ever knowing it was open. And once it closes for good. Today, I'm walking you through that window, what it is, why it matters, and the one trap inside it that can raise your Medicare premiums if you're not careful. As always, this is general education, not personal advice, and the numbers on screen come from the IRS and Social Security's own published figures. Here's the setup. For most of your working life, your income was high, so your tax rate was high. And someday, the government will force money out of your retirement accounts whether you want it or not. Those are called required minimum distributions, or RMDs, and under current law, they begin at age 73. If you were born in 1960 or later, they start at 75. But between the day you retire and the day RMDs begin, something unusual happens. Your paycheck is gone. Maybe you haven't started Social Security yet. Your taxable income drops, sometimes to almost nothing. For a year or 5 years or 10, you may be sitting in the lowest tax bracket of your adult life. That's the window. And here's what it's for. A Roth conversion means moving money from a traditional IRA or 401k into a Roth IRA. You pay income tax on the amount you move this year. In exchange, that money grows tax-free, comes out tax-free, and is never subject to RMDs for the rest of your life. So the whole game is simple to state. You will pay tax on that money eventually, either way. The only question is when and at what rate. Converting during the quiet years means choosing to pay at the lowest rate you may ever see, instead of waiting for RMDs to force the money out later, possibly at a higher rate, stacked on top of Social Security and everything else. And there's a second prize that almost nobody mentions. Money in a Roth doesn't count toward the income number Medicare uses to set your premiums. Every dollar you convert now is a dollar that can't push you over a Medicare premium cliff at 80. Now for the trap. Because there's always fine print, and this one matters. The amount you convert counts as income in the year you convert it. All of it. Convert $100,000 and on paper, you just earned $100,000. That matters for two reasons. First, a big conversion can push you into a higher tax bracket, which defeats the point. Second, if you're on Medicare or within 2 years of it, that income feeds into IRMAA, the Medicare premium surcharge we covered in our last video. Remember the cliff numbers for 2026. Cross $109,000 for a single filer, or $218,000 for a couple filing jointly, even by $1. And your Medicare premium jumps for an entire year. 2 years after the conversion, because Medicare looks back 2 years. So the skill here isn't converting as much as possible. It's converting the right amount each year. Enough to use up the low brackets while they last. Not so much that you spill over a tax bracket line or an IRMAA cliff you didn't see coming. People who do this well treat it like filling a bucket. Each year of the window, they figure out how much room is left below the line that matters for them, and they convert just enough to fill it. Then they do it again next year. Quiet, boring, repeated. That's what works. 3 more pieces of fine print quickly. 1 to roam. Pay the conversion tax with money from outside the retirement account if you can. Using the converted money itself to pay the tax shrinks the amount that gets to grow tax-free. 2, converted dollars generally need to sit in the Roth for 5 years to be fully in the clear. So this is a strategy for money you don't need to touch right away. 3, a conversion can't be undone. Congress removed the do-over option years ago, which is exactly why the amount and the timing deserve a professional's eyes before you sign anything. So who is this actually for? Honestly, the window matters most if you have meaningful money in traditional IRAs or 401ks, and a gap of a few years between retiring and RMD age. If that's you, every year that passes unused is a year of low bracket room you never get back. And who should be careful? Anyone close to an IRMAA threshold, anyone on income-based programs, and anyone whose state taxes conversions heavily. Again, the rule is simple. Your situation is yours. Let's put the whole thing in 1 minute. Between retirement and age 73, your tax rate may be the lowest it will ever be. Roth conversions let you pay tax at that low rate now, instead of a higher rate later, and they permanently shrink the RMDs and Medicare surcharges in your future. The conversion itself counts as income, so the art is filling the bucket each year without spilling over a bracket line or the $109,000 IRMAA cliff. Pay the tax from outside funds, respect the 5-year rule, and get a professional to run your numbers, because there are no do-overs. Bring your tax preparer 3 questions. How much room do I have below my current bracket this year? How close am I to an IRMAA line? And how many years of window do I have left? Those 3 answers are the whole strategy. If this was useful, the next video covers something harder but just as important, the widow's penalty, where the surviving spouse keeps the same income, but the tax bill jumps. The fine print there is brutal, and almost nobody plans for it. I'll see you there.